Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week's episode is number 88. And this week on the podcast, we're covering a topic that's near and dear to my heart, and that's securities lending. Securities lending is something that very few people, even in the finance world, I think fully understand, but is ever present in the market for buying and selling stocks and bonds. And intermittently, over time, securities lending will show up in the news, sometimes for positive reasons, sometimes for negative reasons. It has to do with short selling, and the activity of securities lending helps drive down the cost of investment in the mutual funds and ETFs that you and I both own. So it's a topic that is often misunderstood. I've run across a couple articles recently, and there apparently is activity in one or more Reddit forums that may or may not be factually accurate, but is an interesting subject that I thought would be kind of fun to cover on the podcast. So I cover this in a lot of detail and how it impacts ETF and mutual fund performance and costs, and I hope you enjoy it. Hey everybody, real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. All right. So this week on the podcast, we're talking about securities lending. I have to admit, securities lending is a topic that's near and dear to my heart. It's something I know quite a bit about because I spent the first 7 years of my career on a securities lending trading desk in a couple of different roles, including some management toward the latter parts of that. But the reason I bring it up on the podcast this week is because securities lending is really relevant to the investment funds that you or I might put our money in over the course of our investing life cycles and careers. And that includes both ETFs and mutual funds. And I thought it would be interesting to cover this topic on the podcast today because I have run across more than a couple Reddit threads and other mentions of securities lending that I think are factually inaccurate and causing people in these meme stock forums to jump to conclusions that are rather far-fetched. And I'm not going to include any specific examples there, but since we've had such an interesting experience this year with meme stocks in general, and now Robinhood just went public here this week as I'm recording this, I thought it might be an interesting opportunity to talk about this for a little bit on the podcast today, because securities lending coincidentally is a big driver of revenue for brokerage firms and for funds like mutual funds and ETFs. It really goes a long way toward reducing expense ratios. And for a while here a couple of years ago, there were Fidelity funds, I think. I can't remember whether they were Fidelity or some other fund sponsor, but there were a few funds out there that actually had negative expense ratios for a short period of time to incentivize people to put their money in them. And you have to think, well, why on earth is a fund sponsor going to pay me to put money into their fund? That doesn't make any sense. How are they possibly going to make money off of that? It actually makes a fair amount of economic sense when you think about the way that, or the other ways, I should say, that brokerage firms and fund managers drive revenue and drive profits. But at any rate, it's a really interesting area in the financial markets, and it's one that I think very few people in the broader industry really truly understand. So I'll start at the top here. And you have to forgive me if any of my old friends and colleagues in securities lending are listening to this. It's been a few years since I thought about this stuff, so I'll probably butcher the explanation. But at a high level, anytime you are buying or selling a stock through a brokerage account, what you're doing is giving your broker instructions to go to the market and transact in that security on your behalf. And brokerage firms like Fidelity and like Schwab and like Merrill Lynch have, not just your order going in, but thousands and hundreds of thousands and sometimes millions of clients whom they are also transacting for. Not always simultaneously, of course, but there's a lot of people in that pool that the brokerage firm is responsible for executing trades for. And so if you're trying to buy 100 shares of Apple, chances are very high that your brokerage firm is not going to turn around and enter an order at the market for 100 shares of Apple. They're going to group your order with everybody else who wants to buy Apple stock and put them together in one big block and execute one big order on your behalf. And so when you net together all of the buys, and then you consider all the other clients of the brokerage firm who might want to sell shares of Apple, it may be beneficial to you. You may get better execution to have your broker match its own clients who are selling Apple shares with those who are buying Apple shares at the market price, rather than sending it out to the market itself to go buy and sell and transact whatever that net difference is to some other third party elsewhere in the market. So at any rate, there's a lot of this netting that goes on. But at some point, once you match all the buyers and all the sellers off, let's say that you've got 100,000 shares of Apple you're trying to buy, and you have 80,000 shares of Apple that you're trying to sell. You've got a net of 20,000 that you need to go out to the market and purchase and then distribute back to your various clientele in their accounts. And so that's when they go to the market and buy the shares. Now, for those of you out there who are really familiar and experienced with trading, you probably are familiar with how settlement works. But for those of you who aren't, when you buy the shares of Apple, your brokerage account is going to show that you now have the shares of Apple. Let's say that you had a market order for 100 shares. That trade was executed. Your brokerage account is going to reflect 100 shares of Apple, and it's going to reduce the cash in your account by 100 times whatever the transaction price was. And what's happening on the back end is when Apple or when your brokerage firm has a net amount that they're going to the market and purchasing, they go to the market, they buy the 20,000 shares of Apple, but they're not actually receiving delivery of those Apple shares yet, because stock trades don't settle simultaneously. Back when I was in securities lending, they settled on T+3, meaning that you trade on day one. 3 days after that is when the trade settles. Now, equity trades settle in T+2, and there's a lot of talk from the SEC that they might be interested in shortening that time span further, which in general would be very good, I think, for the functioning and efficiency of the markets. So your brokerage firm doesn't get the 20,000 shares of Apple it's buying on you and all of its other clients' behalf immediately. It takes 2 days. And on T+2, the cash goes out the door, and the brokerage firm is expecting to receive the shares. So that's on a buy transaction. Now let's take the opposite of that. Let's say that we have 100,000 shares of Apple at the brokerage firm that clients are trying to sell, and 80,000 that clients are trying to buy. So they can match off 80,000, and then with the 20,000 share difference, they're going to the market and trying to sell those. Well, when settlement comes around 2 days later, and the predominant way this at least used to work a few years ago, and I think still works in this way, was that you go to the market and there's this entity that offers continuous net settlement. And so if you are a brokerage firm and you've just sold 20,000 shares to Morgan Stanley, another brokerage firm, Morgan Stanley is expecting to receive 20,000 shares of Apple 2 days after the trade date. And if you don't deliver 20,000 shares of Apple when you said you would, they're going to be pretty upset. And there may be regulatory scrutiny around that too, circumstances depending. There's also an entity called continuous net settlement, meaning that rather than one brokerage firm having to deal with JP Morgan and Morgan Stanley and Goldman Sachs and E-Trade and all of the other brokerage firms in a one-on-one engagement, all the brokerage firms transact directly with this central clearinghouse. And so what happens is it's a little bit anonymized, but you owe the 20,000 shares, you as the brokerage firm that is, to the system, to continuous net settlement, and you don't know how they might be dispersed thereafter. So if you're the brokerage firm and you're executing trades on behalf of your clients such that you're allowing them to sell 20,000 shares, well, that's no big deal. If they've got the 20,000 shares of Apple in the accounts, that's no problem. You take their orders to the market, you execute them. When settlement comes 2 days later, you take the shares out of their accounts and send them to whomever your counterparty is, whether it be CNS, Continuous Net Settlement, or another brokerage firm directly, or some other pool of liquidity elsewhere in the market, which is more prevalent these days than it was years ago when I was doing this directly. So that's in general how it works. And when you have the shares long in client accounts, it's a very straightforward transaction. But where wrinkles come into this whole process is when you're executing short sales for your clients. And a short sale is where I'm going to take off my brokerage firm hat and put on my investor hat here. If I'm someone who's trying to sell shares of Apple short, what I'm doing is expecting the value of the shares to fall. And as an investor, you borrow the shares from your brokerage firm and sell them. Let's say that Apple's trading at 100. If you sell them for 100, that means that you have $100 that's cash that's deposited into your account, and you owe your brokerage firm the corresponding number of Apple shares at some point in the future. So if you're right, and the price of Apple falls from $100 to $50, you have $100 cash, you take 50 of it, you go and buy a share of Apple, return the share to your broker and close the transaction, and now you've pocketed $50 in cash. But what happens pretty frequently in these things when prices go in the other direction is what's called a short squeeze. And if the price of Apple instead goes from not 100 to 50, but 100 to 200 or 100 to 300, now all of a sudden the margin, the equity in your account is not sufficient in the eyes of the brokerage firm, and you have to pony up more cash. So it can go against you too. And so if you're wrong and it goes from 100 to 200, you owe the share of Apple back, but you've only got $100 in the account. And so you might have to deposit more cash to buy the shares back to close the transactions. Or if the price goes too out of control and the amount of cash you have or equity in the account goes beyond a certain amount, then your brokerage firm is going to buy you in and take assets in your account, purchase the shares of Apple, and close out the transaction without your discretion. I'm going down a rabbit hole here a little bit, but the whole reason that this short selling transaction works is your broker has the ability to lend you the shares initially to sell them short. And so from the brokerage's firm standpoint, back to our example here, you've got 100,000 people who want to sell and 20,000 people who want to buy. Well, if the 20,000 extra that you need to sell more than you can net against your people who want to buy, if those shares are long in the client's accounts, if they're selling shares that they already own, it's no big deal. But if you're allowing your clients to go short and sell the shares without owning them first, guess what? You still have to deliver the 20,000 shares to whomever out there in the world is buying them from you. So back to, say you're transacting with Morgan Stanley, you have the 20,000 shares in client accounts, you take them out because you've already executed the trade, you hand them to Morgan Stanley in 2 days, Morgan Stanley hands you cash, and the transaction is done. But if those clients are short sellers, then you're allowing that trade to happen. You're selling the shares to Morgan Stanley, and you got to go find them from somewhere, because Morgan Stanley is expecting to receive shares here on T+2, and if you don't deliver, they're not going to be very happy. So this is where securities lending comes into play, because as the brokerage firm, all major brokerage firms across the country have securities lending trading desks where they borrow and lend securities between each other to facilitate these transactions. And so if the example is true and you actually need to, if you're short 20,000 shares of Apple, well, Apple is a huge company with millions and millions of shares available. It's liquid. It's very easy to find out there on the market. It's like water, really. It's ubiquitous. It's very easy to find shares. And so you go and borrow them from another broker, promise to give them back at some point in the future, and then you lend them or deliver them to Morgan Stanley to close that transaction. So that's how this works. Is the demand for securities lending is driven by short selling, and it's driven by the settlement system that goes on behind the scenes in the brokerage world. Now, it's not terribly profitable for brokerage firms to lend shares of Apple. And what most of the brokerage firms out there do is they lend a security. It's collateralized with cash. It's actually 102% of the value of the security that's being lent. So if I need to deliver 20,000 shares of Apple to Morgan Stanley, and I need to borrow it from some other firm, let's call it E-Trade, then I borrow 20,000 shares from E-Trade and I give them cash in return, 102% of what the market value is. And then as the value of the Apple stock fluctuates, that collateral gets marked to market every day, and I may have to pony up more cash, or I may have cash returned to me depending on how what the price does of the underlying shares. So Apple is an easy stock to find. And as a borrower of Apple stock, you're not going to have to pay very much money, because this market, like any other, comes down to supply and demand. It's easy to find. It's out there everywhere. You don't have to pay hardly anything to get it. But the shares that are very highly demanded in the market, so for example, GameStop would have been a good example of this. I don't know what the cost was in the securities lending market when this was going on earlier in the year, but any of these meme stocks, I suspect, that are smaller in size, so small cap names tend to be harder to find. And when you have less supply and more demand, that makes the price to borrow go up. And so as a borrower, or as a brokerage firm, I should say, if you're allowing shares of GameStop or some other popular small cap name to be shorted, you better make darn sure that you can actually find the shares. Either you have them in your inventory, or you can deliver them to whoever is buying, again, Morgan Stanley in this example, or any other person you're selling the shares to on the other side of these short sale trades. You better be sure you can find them and deliver on T+2. Because if you don't, there is substantial regulatory scrutiny around that, and brokerage firms do not like to fail any longer for that reason. And so for your small cap names, if you have shares of GameStop or another stock that is in high demand in the short selling market, you can make a fair amount of money by lending them out. Now, it gets a little complex. I hope I haven't lost you yet, but there's a couple different sources of supply in the securities lending market. One of them is as collateral for margin accounts. So if you have an account at Schwab or Fidelity or wherever else, and that account is on margin, guess what? The collateral for the margin loan that you've taken out with that brokerage firm are the stocks in your account. And so based on the agreement you have on that margin contract, if you're borrowing money to buy securities at your brokerage firm, they can do what's called hypothecate, which is an industry term, complex sounding, but they can take the shares from your account and lend them out for profit to the firm, to other short sellers, to other brokerage firms, really wherever they want. And you don't see the shares disappear from your account. You have the right to sell them, whenever you want, of course, pursuant to your margin balances and so forth. But your brokerage firm is likely, in a situation like GameStop, if you're on margin and you're buying GameStop shares, that's a security I would guess was probably highly demanded in the market. They're probably taking that out and lending it to a short seller elsewhere in the world. So that's one source. When you're on margin, your shares are available for your brokerage firm to lend. The other source is shares that are not on margin. And if you have accounts and you've been approached by your broker to lend shares to them in a fully paid lending situation, that's what this is. There are short sellers out there who want to borrow the shares to sell them short. There's a lot of demand. People are asking your broker to borrow shares from them. And because they have no right to touch the shares in your account if you're not on margin, then you can lend them to the brokerage firm for a fee, of course. They pay you money for that. Your brokerage firm turns around and lends that to some other party in the market, and they make some money on it too. And I don't know what portion goes to the brokerage firm and what portion you as the investor get these days. I suspect it's pretty equitable. It's definitely been moving in that direction. But in your investment accounts at, again, Morgan Stanley, Fidelity, wherever, that your shares are not going to be touched if you're not on margin. If you are, they're likely being lent without you knowing it. If you're not on margin, they might approach you if you have a stock that's in demand that they want to borrow from you. Which brings us to what's more relevant to what we're talking about today: ETFs and mutual funds. So that kind of covers, that gets us up to speed on why there is this movement and borrowing and lending securities. It's a for-profit thing for brokerage firms, and they're trying to enable their own clients to sell stocks short when they want to, because it's a service that they can offer, and they want to take the inventory that the brokerage firm has as a result of margin and fully paid for accounts. They want to use that inventory thoughtfully to drive revenue and net interest margin for the firm, and it's a really profitable thing for the brokerage firm. Now, from the perspective of ETFs and mutual funds, this is the third area of supply in the market. So let's say you're investing in an S&P 500 mutual fund. Well, from the portfolio manager standpoint, they're taking money from you, investing that in proportionally in the S&P 500, and giving you shares of their mutual fund. And the shares of the 500 S&P companies that are sitting in a trust account somewhere at a qualified custodian are fully paid for. And if there's demand to borrow those shares on the securities lending market, then the manager might be lending them out to the same parties that you would if you had them in a margin account or a fully paid for account with your discretion. Now, with the S&P 500, there's not a whole lot of demand to borrow the shares because they're the 500 biggest companies by market cap in the country. And so there's not a whole lot of activity from a demand standpoint with S&P 500 funds. But there's a whole lot of activity with Russell 2000 funds, small cap, more obscure names, because again, think of supply and demand. Smaller companies, the small cap names, all a little bit less analyst coverage. Oftentimes, they're not quite as strong financially, and they're short selling targets. And so there's more demand and less supply, which makes them a more lucrative opportunity for the manager of your mutual fund to lend them out. So if the shares are just sitting there and you own them, along with all the other investors in the same fund, if they're just sitting there, not doing anything, you might as well lend them out and earn a little bit of extra income that comes into the portfolio as a result. And so that's exactly what mutual fund and ETF managers do, is they lend. Now, ETFs are a little bit more complicated, and I'm not going to touch that today because their shares of the ETFs are exchanged for the underlying stocks, and then their new shares of the ETF are created and existing shares are destroyed based on supply and demand. I'll cover that technicality another time. But with mutual funds, it's a nice driver of return. And the way that return shows up, it doesn't actually add to your net investment return if you're investing in a Russell 2000 mutual fund. What happens is it works against the expense ratio that you pay. So back to my example at the beginning of the episode, you have a few of these, and again, I think they were Fidelity a couple of years ago, funds that had negative expense ratios. It's because there was a lot of money being made by securities lending at the time, which enabled the funds to reduce operating expenses into negative territory, to where the revenue from securities lending actually exceeded the operating costs of the fund, which I'm sure the marketers really loved because now they can market a fund with negative expense ratios, which is kind of crazy to think, but that's how it works. So it's a really interesting sector of the market, I'll say. There are a lot of parties out there in the world who want to sell stock short. It's active traders who are trading their own account. There are mutual funds out there that have long short strategies or short only strategies. They're betting against the market or against individual companies. Hedge funds are the predominant driver of demand. They short stocks all the time in pursuant to various strategies. And so there's a huge demand to borrow various securities for various reasons over time. So as it relates to our holdings in mutual funds, this is a good thing because the more juice that a prudent securities lending trader, manager, team, whatever you want to call it, securities lending group, the more juice they can squeeze out of a universe of stocks that you own in a portfolio with a bunch of other shareholders, the better off you're going to be. The more money they can lend, or the more money they can make by lending the underlying stocks in the portfolio, the lower your costs are going to be and the higher your returns are going to be. And so we like that. The other interesting thing here, and this is an argument that I used to hear all the time, was that you might not want your shares to be lent out because you don't want to facilitate short selling in a company that you own, which seems to make sense on the surface of it, right? If there's a short seller out there who wants to sell the stock that you own, they don't own it, they can't sell it without borrowing it from you, why would you want to facilitate that? Because their sell order could help drive down the price. And I don't know of any studies that look at this directly, and that could be true. My sense, at least, is that it could be true in the short term, but in the long term, it's probably not going to matter a whole lot. And there are so many participants in the market in general that whether they borrow the share from you or they borrow the share from somebody else, they're going to get the stock to short somehow. There are not that many names out there that are totally shut down from shorting in any given time. There are a few, as I recall, that are completely shut off from shorting because it's not possible to find any shares. But that's kind of few and far between, to be honest. So it seems counterintuitive that you'd want to participate in this to enable some other market participant to to help drive down the price of something you own, but they're going to find it anyway, in my opinion. And again, it's been a few years since I was in this world, so the landscape may have changed a little bit. There may be some more definitive evidence one way or another there. But it's a really interesting thing. And coincidentally, I've had Kelly Klingeman, who's at Dimensional Fund Advisors, on the podcast. It's been a while. I should probably have her back. But she is really in tune with what DFA is doing. Of course, she works there and is an advocate for them. But with their securities lending program, since DFA tilts their portfolios toward small cap, toward value, really small cap is the more relevant factor here. They have larger holdings in these small companies that have a lot of demand to be shorted in the first place. So you'd think that they do pretty well with revenue in that department because they have a lot of those holdings that people want to borrow out there elsewhere in the market. And coincidentally, they're looking at they're building portfolios by buying everything in a universe, large cap, small cap, foreign, domestic, whatever, and then they're tilting that portfolio toward value, small cap, and profitability in various degrees. But when it comes to buy or sell specific securities for any one of their mutual funds, the portfolio manager is looking at momentum. They're looking at price targets and so forth. So if a bunch of other people out there in the market are buying the same stock at the same time and the price runs outside of the range that they're trying to pick it up for, they won't buy it. They'll wait until the next day. They have these flexible trading parameters, which is really helpful in getting better execution. But at any rate, the momentum factors that they're looking at, demand to borrow the shares in the securities lending market, is one of the exact things they look at in trying to decide whether or not to buy or sell a security on this given day or to wait and hold off. Because if there's something that they think they want to add to their portfolio, but there's a whole lot of demand to borrow in the lending market, maybe you want to wait for that short-term price movement before you add it. And alternatively, if you have something in the portfolio, you want to sell it, but the price is not moving in your direction. If there's a whole lot of short demand out there still, maybe you want to sell it even though you're not getting the price you want, because it might be more likely to fall further in the short term. So it's a really interesting data point for really a technical indicator, I would say, as opposed to a core fundamental of company operations. But it's something that fund managers look at, is what's going on in the securities lending market, as they should, because it's relevant. So at any rate, we got a little bit technical today. I hope I didn't turn anybody off or bore you too much. But when you hear about securities lending, it has to do with short selling. It has to do with settlement and delivery of stocks at the brokerage firm level. And if you have the opportunity to engage in the securities lending market because you own shares of a company that you want to own, you're not planning on selling it anyway, but you own them, there's demand to borrow them, and your brokerage firm approaches you and asks to borrow them from you so that you can participate in this, I would be an advocate to probably do it. Every situation is different. I can't across the board suggest that. And of course, this isn't advice, as our disclaimers clearly state and everything. But it's generally a good thing for investors, because if you're holding it, again, the short seller is going to get it, whether it's from you or somebody else. You might as well make a little bit of extra money off of it. Okay, that's it for today. Hope this was helpful, and I will talk to you all soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.